Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. This is part 1 of Optimizing Investments with Monte Carlo Simulation, a practical guide. Ever wondered how investors handle uncertainty in the stock market? Monte Carlo simulations have become a valuable tool for tackling this challenge. These simulations use random sampling to model the probability of different outcomes in investments. By analyzing countless scenarios, investors gain insights into risks and potential returns. In a world where markets can be unpredictable, understanding Monte Carlo methods can give your investment strategy a significant edge. This video will walk you through the basics and show how you can apply this technique to make smarter financial decisions. Understanding Monte Carlo Simulation. Monte Carlo simulation is a powerful tool that helps investors understand the uncertainty of financial markets. So, what exactly is it? At its core, Monte Carlo simulation is a technique used to model the probability of different outcomes in any process that involves uncertainty. By running numerous simulations, investors can get a clearer picture of what might happen in the future, aiding them in making informed decisions. History and development. The roots of Monte Carlo simulations can be traced back to the 1940s during World War II. The method was named after the famous Monte Carlo casino in Monaco, reflecting the concept of randomness akin to gambling. Early pioneers of this technique included scientists like Stanislaw Ulam and John von Neumann. Ulam, working on nuclear weapon projects, initially conceptualized the idea while recovering from an illness, pondering over probabilities in solitaire card games. By collaborating with von Neumann, who was a brilliant mathematician, they advanced the use of random sampling for computer simulations. Over the decades, the applications of Monte Carlo simulation have expanded far beyond nuclear physics, becoming integral in fields such as finance, engineering, and biology. How it works. At its simplest, Monte Carlo simulation operates through random sampling and statistical modeling. Here's how it typically unfolds. Define a model. Start by establishing a mathematical model of the process you're interested in. This could be the potential returns of a stock portfolio or the failure rates of an engineering system. Input variables. Identify the variables that are subject to uncertainty. In investments, this could be factors like market returns, inflation rates, or currency fluctuations. Generate random inputs. Randomly generate possible inputs for these variables. This process uses probability distributions, like normal or uniform distributions, to ensure that the random samples accurately reflect the real-world uncertainty. Simulate. Run the model hundreds or thousands of times, each time using randomly generated inputs. Each run produces a different outcome, providing a spectrum of possible results. Analyze outcomes. Analyze the range of outcomes to ascertain probabilities of various results. For example, you might find that there is a 70% chance that your investment returns will exceed 5% over the next year. Monte Carlo simulation turns uncertainty into something you can work with by giving it structure and predictability. Think of it like trying to predict the weather. By simulating numerous weather patterns, meteorologists can provide forecasts with reasonable accuracy despite the inherent uncertainty. This process allows investors to see the big picture, understanding both the risks and potential rewards. Importance of Monte Carlo simulation in investing. In the ever-shifting landscape of investing, Monte Carlo simulations are like a compass guiding investors through uncertain terrain. These simulations provide a way to visualize the future by generating a multitude of potential outcomes based on different variables. Why should this matter to you? Because it empowers you to navigate the complexities of risk and scenario planning with confidence. Let's explore how this tool can refine your investment strategies. Risk assessment. Risk is the shadow that follows every investment decision, lurking in the form of volatility and market downturns. Monte Carlo simulations shine a light on these shadows by giving investors a quantitative grasp on potential risks. How does it work? By running thousands of simulations, investors can visualize a complete spectrum of possible outcomes. This isn't about predicting the future with a crystal ball. Instead, it's about understanding what might happen under different circumstances. Say you're contemplating a new stock pick. Instead of trusting your instincts or past performance alone, you can use Monte Carlo simulations to evaluate risk exposure. The simulation will provide a range of possible returns, taking into account various market conditions, giving you a clearer sense of the potential pitfalls and rewards. By understanding these risks, you can prepare for the what-ifs of investing rather than reacting to them. Scenario analysis. Markets are unpredictable, like a roller coaster ride with unexpected twists. Scenario analysis through Monte Carlo simulations allows investors to strap in and test the ride's outcomes. What does this mean in practical terms? You can consider different market scenarios, high inflation, recession, or a sudden boom, and see how these conditions might impact your portfolio. By simulating various market conditions, you prepare yourself for a range of potential futures. Imagine planning a road trip without checking the weather forecast. It might rain, snow, or shine. Of course, you'd pack differently for each scenario. Similarly, investors can adjust their portfolios based on the different scenarios demonstrated by Monte Carlo simulations. This proactive approach allows for a robust strategy that isn't just ready for the sunny days but also equipped for storms. In essence, Monte Carlo simulations transform investing into a strategic exercise, guiding investors to plan with foresight rather than hindsight. Just as a chess player considers their opponent's potential moves, investors can use this tool to anticipate market shifts and adjust their strategies accordingly. Incorporating Monte Carlo simulations into your investment strategy isn't just about crunching numbers, it's about creating a roadmap that helps you navigate uncertainties with clarity and conviction. Applications of Monte Carlo simulation in investment strategies. Monte Carlo simulations aren't just for mathematicians and data scientists, they're a goldmine for investors looking to boost their strategy game. By running massive simulations, investors can predict various scenarios and make choices with a bit more confidence. Let's explore some specific areas where these simulations work wonders in finance. Portfolio optimization. Figuring out the best asset mix in a portfolio is no walk in the park. But Monte Carlo methods make it a whole lot smoother. Imagine you're trying to whip up the perfect ingredients to bake a cake. You need the right balance. Too much flour, and it's dry, too much sugar, and it's overwhelming. Likewise, in investing, it's all about finding that sweet spot between risk and return. Monte Carlo simulations help you test hundreds or even thousands of different asset combinations. They use historical data and random variables to assess potential outcomes. This way, you're not just guessing but making informed decisions about where to place your bets. They help identify patterns and probabilities, leading you to a more optimal asset mix with confidence. Option pricing. Pricing options and derivatives can feel as complex as deciphering a new language. That's where Monte Carlo simulations step in to translate. They're vital in assessing how an option might perform under different circumstances. Options are contracts granting the right, but not the obligation, to buy or sell a security at a set price within a specified time. Kind of like deciding whether to hang on to that gift card before it expires. Monte Carlo simulations model various factors that influence an option's value, like volatility and time to expiration. By running these simulations, you can estimate how options might behave, seeing the larger picture rather than a snapshot. Wealth management. When it comes to managing wealth, Monte Carlo simulations are like having an insightful advisor. They help wealth managers create realistic, flexible financial plans for their clients. Imagine planning a cross-country road trip. You'd want to know if your car can make it up those steep hills or coast through flatlands. Monte Carlo simulations do precisely that for a client's financial journey. They analyze income streams, expenditures, and market conditions, forecasting numerous outcomes. Wealth managers can then devise strategies to avoid financial potholes. By considering various life and market scenarios, they help clients stay the course, adjusting strategies like recalibrating a GPS, ensuring they reach their financial destinations. In leveraging Monte Carlo simulations, investors transform unpredictability into a navigable road, optimizing portfolios, pricing options accurately, and managing wealth with precision. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.